Hilton Hotel by Tilly Dudley Wang Johnson Carries. Hilton Hotel is the largest hotel group in the world. 3,715 locations, over 610,000 rooms across 84 countries, and over 100,000 employees. Hilton has 10 well-recognized brands and 3 business segments: management and franchise ownership timeshare. In 1990, Conrad Hilton purchased the first hotel in Texas. 2007, Hilton acquired by Blackstone and Crispo became the CEO in the same year. In 2009, created global business.
Blackstone Group was founded in 1985 by former colleagues Peter G. Peterson and Stephen A. Schwarzman. They are located in New York City. The company is comprised of 5 business segments: private equity, hedge fund solutions, credit advisory, financial advisory, and real estate. The real estate segment has an investing approach that is guided by several principles, which include a global scope, capturing exclusive opportunities, superior financing expertise, operations oversight, and a strong focus on value creation. An interesting fact about Blackstone is the way the company was named. They did it by using anagrams of their names. Schwarz means black in German, and Peter, or Petra in Greek, means stone. Put them together and you get Blackstone. Originally, the company was a mergers and acquisitions advisory firm. As they grew, their business model expanded and a fund of hedge funds business was launched, as well as a real estate one. Notable investments by Blackstone include the following: Allied Waste, American Axle, Prime Hospitality, Legoland, La Quinta, and Luxury Resorts. The rationale for the acquisition of Hilton was driven by Blackstone's expanding hotel business. Approximately $15 billion worth of hotel chains had already been acquired. Once the Hilton deal closed, Blackstone would own, manage, or franchise the rights to 3,700 hotels, which represents about 600,000 rooms. After acquisition, the plan was to invest in the Hilton properties and brands globally to grow the business for the benefit of the owners, franchisees, and customers. Over the past 15 years, Blackstone has been the largest private investor in hospitality worldwide and has a strong track record of reinvesting in its properties.
There was no direct competition for the Hilton deal or any joint investors. The top firms as of 2007 were Blackstone, KKR, the Carlyle Group, Texas Pacific Group, and Bain Capital. The Hilton deal ranks number 10 for the biggest leveraged buyouts of all time. Notice that all but 2 of the biggest deals were done in 2006 and 2007. The Hilton deal is also known as the high water deal, as it was completed right before the credit crisis. KKR was the most comparable firm of 2007. Blackstone went public June 2007, and KKR announced same intentions the same day as the Hilton LBO was announced. However, their IPO was delayed due to the credit crunch. The first half of 2007, KKR had 10 deals valued at $114 billion, and since then has completed 6 deals at $7.9 billion. Blackstone, during the same period, had 10 deals valued at $35 billion, and since the Hilton deal have not had a transaction greater than $5 billion. There was an insider trading allegation and conviction prior to the Blackstone's announcement of their intentions to buy Hilton. An analyst at Moody's informed Raj Rajaratham, Galleon Technology Fund, of the deal. Galleon Technology Fund bought 400,000 shares at $35.13 prior to the announcement and sold it after the announcement for between $45.25 to $45.63, creating a $4 million profit for the fund. This information was also most likely leaked further, as Hilton trading volume doubled before the announcement. In 2009, Starwood Hotels and Resorts, a competing hotel chain, sued Hilton for corporate espionage. Their claim was that 2 of Hilton's executives stole 100,000 electronic files. These files were claimed to be used in starting rivalry luxury chain Denzian. The result was Hilton settling, making a $75 million cash payment, Starwood being entitled to $75 million in hotel management contracts. Hilton was prohibited from introducing any lifestyle hotels for 2 years, and Hilton's operations would be supervised to ensure their compliance.
There are some banks that provide Blackstone with debit finance for Hilton LBO: Bank of America, Goldman Sachs, Blackstone, Merlin, Deutsche Bank, JP Morgan, Lehman Brothers. Blackstone bought by JP Morgan, their $4 billion of Hilton debit absorbed by Federal Reserve and passed on to taxpayers. Blackstone paid 47.50 a share. This is 14.2% higher than the day before the announcement price of 33.87. Also, it is 26.6% premium over the all-time high of $37.53.
The debt financing of the transaction includes $11.5 billion of senior mortgage notes, $8.6 billion of secured mezzanine loans, and $500 million of unsecured notes for a total of $20.6 billion of new debt. In addition, Blackstone contributed $5.7 billion of equity and had access to $550 million of Hilton's excess cash. The largest financing holder was the Maiden Lane Grantor Trust, as they held interest in both the mortgage notes and 9 of the 11 mezzanine tranches. Blackstone spent these funds in several ways. The main use was the purchasing of $19.4 billion of common stock at $47.50 a share. They also bought $8.9 million of options in retired stock. They retired $3.9 billion of existing debt. The rest was put towards other various expenses and fees. There is a discrepancy between the sources and uses of the funds in our model, but they are most likely fees paid to the banks, as we cannot find the exact numbers for these. We constructed several different leverage and ratio models. The debt Hilton had on their books at the time of acquisition was $5.3 billion. Combined with the new debt, the total debt after the acquisition was $25.9 billion. This gave us a leverage ratio of 4.2, which was lower than the 5.8 average leverage ratio from 2006 to 2007. Hilton's debt to equity went from 1.43 before the purchase to 4.99 after the purchase. Their senior debt to EBITDA was 11.5, which was significantly higher than the 2007 average of 5.4. Their total debt to EBITDA was 20.5, which also was higher than the 2007 average of 6.25. Two acquisition multiples we used were enterprise value to EBITDA and enterprise value to revenue, which were 24.7 and 3.8 respectively. These two numbers are commonly used in LBOs to help determine the fair value of the target company. The first restructuring of Hilton occurred in 2010. It included converting tranches J and K into $2.1 billion of preferred equity. They also retired $1.8 billion from tranches G, H, and I. The maturity date of all the tranches were extended to November 15th, and the interest rate was increased. The result of this restructuring was a reduction of nearly $4 billion of debt. There is a plan in place to restructure Hilton's debt this year before their upcoming IPO. This includes raising $5.85 billion in loans, selling $3.25 billion of bonds, and selling $3.5 billion of commercial mortgage-backed securities. This would be the largest commercial mortgage-backed security sale since the credit crisis. In addition, $1.25 billion would be raised by the IPO itself. Recently, Standard & Poor's gave Hilton a double D- credit rating. They said this was largely due to the still highly leveraged balance sheet. This chart represents Hilton's debt levels at various points in time. The blue stack is Hilton's debt right before being acquired. The red, which is right after the acquisition date, represents $20.6 billion of debt used. The green shows the results of the 2010 restructuring, which was quite substantial. The purple stack represents their current debt levels, which will certainly be quite different after the proposed current restructuring.
Hilton recently filed a $1.25 billion maximum IPO prospectus. The offering will be underwritten by 4 banks. The use of 4 banks gives the impression that these banks may have a weak appetite for the risk involved in this offering. Despite the risks involved, Hilton has had strong growth the past 3 years. Their EBITDA for 2010 was $1.564 billion, for 2011 $1.753 billion, and 2012 $1.956 billion. According to a source familiar with the valuation methods of Blackstone, the firm values Hilton at a 50% premium. This averages to an annual geometric return of 8.45% for the past 5 years. A big chunk of this increase in value is due to debt restructuring, which saved Blackstone $4 billion. This accounts for nearly half of the increase in value. The hospitality industry performed poorly due to the financial downturn of 2008. The capital made available to Hilton by the Blackstone Group enabled the company to finance construction and other purchases that enabled faster growth at a time when Hilton might not have had the option to invest in growth projects. Overall, we believe Blackstone did not do as well with this investment as they thought they would. Had Blackstone not been able to restructure the Hilton debt, this deal could have been a major bust. Fortunately, they did make a return. In our opinion, Hilton would not be doing as well today if Blackstone had not bought it and provided resources to grow the company. Overall, the deal was golden for Hilton and mediocre for Blackstone.